Hello and welcome. If you've ever found yourself just staring at a gold chart, feeling completely lost in all that volatility, then you are definitely in the right place. Today, we're going to break down an incredibly powerful tool that's designed to cut right through the noise and give you a clear sense of direction. It's called the moving average. Let's dive in and see how it really works.
You know the feeling, right? You're looking at this chaotic candlestick chart, prices are just bouncing all over the place, and you're thinking, where is this market actually headed? It can feel like trying to navigate a ship in a storm without a compass. But what if I told you there's a tool that can calm those waters and show you a clear path forward?
Well, that's exactly where the moving average, or MA for short, comes into play. Just think of it as a way to bring some order to all that chaos. It's a fantastic tool for helping us see the real underlying trend of the market. So, let's break down what it is and why it's so darn essential.
At its heart, a moving average is actually pretty simple. All it does is take the average price of something, like gold, over a specific number of days, let's say the last 10 days, and it plots that average as a single point. As each new day passes, it just keeps doing that calculation, and what you get is this beautiful, smooth line. It's kind of like smoothing out a really bumpy road so you can finally see the actual direction you're heading.
Okay, so why is that so incredibly useful? Well, for one, MAs help us see the trend way more clearly by filtering out all those random scary price spikes. They use the past to give us clues about the future. And here's the really crucial part. They often act as dynamic support and resistance levels, like a moving floor or ceiling that the price bounces off of. It's all about finding these predictable patterns in the market.
Now, to really get the most out of this tool, we need to understand how it behaves. There are a couple of core features that, once you learn to spot them, will totally change the way you read a chart. So, let's get into the most important ones.
First up, we have what are called trend arrays. This is what happens when you use a few different MAs at once, like a short-term, a medium-term, and a long-term one. When they line up just right, it's a huge signal. A bullish array is when they stack up perfectly below the price, almost like they're pushing it higher. And the bearish array is the exact opposite. They stack up above the price, weighing it down. These are some of the most powerful visual cues you can get for a strong trend.
And here is what that looks like in the real world. I mean, this illustrates it perfectly. On the left, you see those MAs all stacked up nicely underneath the price. That is a classic, powerful bull run. And on the right, you guessed it, the mirror image. The lines are stacked on top, screaming downtrend. Learning to spot these formations is your first major step to trading with the flow of the market. All right, now for a really important point you have to remember, time lag. See, because moving averages are built using past prices, they are always, by definition, a little behind the live action. They lag. A shorter-term MA will react quicker, while a longer-term one is going to be slower but more steady. Understanding this lag is absolutely key because it helps you confirm that a trend is real and helps you avoid getting faked out.
Okay, that's enough theory. Let's get our hands dirty. How do we actually use this for trading gold? Because the settings you pick are so critical. The right parameters are what will help you zero in on entries and manage your trades. So let's get our charts set up right now.
Now, according to the source material for this whole breakdown, there's a really powerful combination of settings that works especially well for gold. We're going to use 4 different periods, a 9, a 20, a 54, and a 72. This specific mix is designed to capture the unique rhythm of the gold market, giving you a complete picture from the superfast trend to the long-term one, all on a single chart.
And don't worry, setting this up is super easy. Just go into your trading platform, find the moving average indicator, it's usually under trend indicators, and add it to your chart 4 times. For the first one, set the period to 9 and pick a color, let's say red. Then just do it again for 20, 54, and 72. And this is important. Make sure you give each one its own unique color. Trust me, you'll thank yourself later when you can tell them apart in a split second.
All right, our charts are set up and looking good. Now it's time for the magic. We're going to introduce the core strategy from our source material. It's a simple but really elegant rule they call the first MA theorem, and it is all about finding those high probability entry points.
So here's the secret sauce. Once you spot a strong, obvious trend, either up or down, you do nothing. That's right. You don't chase it, you wait. You patiently wait for the price to pull back and touch one of your moving averages for the very first time. That first little touch, that's your signal. It's like the market is just taking a quick breath before it continues on its journey.
And this chart shows it in action beautifully. You don't even need to read the text, just look at the arrows. You can see this powerful downtrend, right? And the arrows are pointing to the exact moments the price rallies back, kisses one of the moving averages, and then continues to fall. Each one of those touches was a textbook entry point to sell short.
Let's look at one more example, just to really hammer this point home. Again, just focus on the pattern here. Look at how the price consistently respects these moving average lines. They're acting like a dynamic ceiling, a resistance level. The price rallies up, tests the line, gets rejected, and continues the downtrend. This pattern can happen over and over, offering multiple clean entry points for a trader who knows to wait for it. And here's the most incredible part. According to the source material, when you combine this first pullback strategy with really strict risk management, we're talking a 30-point stop loss and a 60-point take profit. It has a claimed accuracy rate of over 90%. Now look, that is a massive claim, but it just goes to show you the potential power of being disciplined and waiting for these very specific, high-probability setups.
So there you have it. We've covered the what, the why, and the how of using moving averages to trade gold. We've set up the tool, we've broken down the charts, and we've learned a really potent entry strategy. So the only question left is the one for you. Now that you have this knowledge, how are you going to use it to spot the next big opportunity on a live chart? That's your mission. Thanks so much for joining me.